Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast, where we talk all things money and business. My name is Christian Allen, and I'm with my co-host, Rod the Pod Zabriskie. Rod, did you notice that I dropped the Rodney so it rhymed appropriately today?
I didn't notice that, but I'm glad you pointed it out because it does.
I've
a little
been
more
given
flow. A little more flow.
Yeah. Well, what's weird is when I say it, it has less flow, but I've been given a hard time from people, a couple people about that. They're like, well, Rodney doesn't rhyme with pod.
It's poetic
Anyway,
though, all the same.
Okay. All right. Well, anyway, Rod, what's going on, man? How are you?
Doing great. It's a kind of a low volume week for me this time. No crazy announcements to make. So
all right. Well, sometimes you need a low key weekend, especially the irony on that, Rod, is thick. Sometimes you need things to be low key, right?
You're grateful for it.
Let it go.
Yep.
Okay. So today we're super excited to have Sam Primm with us. Sam's a prolific real estate investor. He owns Faster Freedom. He co-hosts a podcast. He's got all sorts of stuff going on. So it was a really fun interview, but talk to us, Rod, a little bit about who Sam is before we get into the actual interview.
Yeah. What's funny about Sam is he describes himself as an ordinary guy, but he's done some pretty impressive things. So you talked about investing
in a short time.
Right. Yeah. So on his real estate portfolio, it's worth, roughly 40 million, right? So, no big deal there.
Mm-hmm.
His social media following is enormous.
Insane.
He has, they recently did the podcast, but he talked about 10,000 downloads in their first month. So, it's not
pretty
like
good. Solid.
world beating, but it's,
it's solid.
Great
That's
start,
really good.
Great start. He's in the St. Louis area. And one of the things I thought was really cool is his just focus on relationships. So when he was building this whole thing, it's not him out there beating his chest. It's him out there surrounding himself with professionals, experts in all kinds of different areas to do what he's done. And so he kind of focused on that as well. So, and then you mentioned the podcast again. He said a couple months ago they started it, but it's called Ordinary Guys, Extraordinary Results. And just a really impressive guy.
Yeah, and it was fun. I've listened to a few of the episodes, and I thought it was a lot of fun. So I would encourage people to go check it out. One of the things I liked about Sam is that he's got kind of two facets going on. He's got the digital world, right? He's got the social media presence, which is enormous and kind of crazy to have built it up in such a short time. But then all of his real estate is very personal touch, local, community, building relationships. So it's kind of interesting. And, he's got both of those sides going on, which is really cool. Okay, Rod. Well, without further ado, then let's bring in Sam Primm, co-owner of Faster Freedom and co-host of Ordinary Guys, Extraordinary Results. We are very excited to have with us Sam Primm, a prolific real estate investor, co-owner of Faster Freedom. He's also the co-host of a popular podcast, Ordinary Guys, Extraordinary Results. So Sam's got a ton of stuff going on. Sam, thanks for coming on with us. We appreciate having you.
I appreciate you guys having me. I'm excited to dig into some cool topics.
Okay, Sam. So the first couple of questions are going to be kind of the get to know you questions, but maybe a little bit different spin on it. So first off, I know from other podcasts that I've listened to, you said you started down a fairly traditional path, went to college, got a job. But here's the question. What was it that flipped the switch? What changed? What created this change from you going from that world to this, I say new, but world you've been in for a fairly long time now, the world of real estate?
Yeah, I think it was just I was on that path, like you said, of, high school, college, job, retire when you're 65, 401k, all that stuff that most people are taught. I think it was a combination of things. Part of it was reading some books like Rich Dad, Poor Dad, and realizing there's other options out there. I didn't even ever think of really becoming an entrepreneur. Like I did, my own lawn mowing business in high school and painting business in college. So I did a few things, but those were just for beer money, I
Make
guess.
some
When I turned
cash, yeah.
21, they were for beer money. But that was more for that. It really wasn't a future path for me, I didn't think. But reading books and seeing other people do it. And then also, I think a big part of it was that competitiveness that I had growing up playing sports and doing all that for, not at, a prolific professional level, but playing competitive sports for 15 years of my life. That's a long time to just have those go away. So I think college, and then, my job for a few years and just missing that because I didn't really get that from my job. I enjoyed my job, but I wasn't having that competitive drive of, trying for something, failing, succeeding and all that. So I think I was looking for an outlet for that competitive spirit in me to go out and try to do more than just what my boss told me to do.
Yeah, very cool. And what are 3 things that you've accomplished up to this point in your life that you're genuinely proud of?
The biggest thing I'm proud of is my family. I have a wife of 10 years here in a few weeks, and then 2 daughters.
Awesome.
I got a 6-year-old daughter and a 6-month-old daughter.
Nice.
So those are by far the most important thing and my favorite accomplishment. Getting that off the table, I think that's most people's why and most people's reason for doing this. Couple biggest accomplishment is I've been able to buy $40 million worth of real estate without using any of my own money, which is kind of one of those things that just has snowballed. And I don't really know, even though I talk about it all the time, that I understand how cool that is and how life changing that is for my daughters and their kids and their kids, what that will grow into. And then the other thing is that this dang social media thing. I picked up my phone about 2 years ago and decided to start social media, and I got a couple million followers between all the platforms. So that's just been a struggle dealing with the algorithms and the hate and the positivity and just the grind that it takes to grow, as you guys know. So that's a big accomplishment because I feel like most people just give up when they hit those roadblocks, but pushing through and seeing the benefits the other side has been pretty cool to see.
Absolutely.
That is super cool. And you have a ton of followers on in social media. It's impressive. And it's not easy to do. You have to be dedicated, right? Like it doesn't just happen by accident. Like you've got to be pretty focused and dedicated. Is that your experience?
I think the word is you have to be a psychopath like I am to just continue to do it. Right. I mean, after weeks of or even months of posting on social media, getting 50 views, 100 views, and just continuing to either have the drive, the psychosis, or the competitiveness, or the stupidity, whatever it is, to kind of keep pushing and analyzing things. And I spent about 30 hours a week on social media there for about 6 to 12 months to really start to gain traction. Fortunately, I had other businesses that supplemented my passive income as well as active income, so I was in a unique situation where I could spend that time. But yeah, it's a lot of grind to get to that point. It doesn't happen easily when, as you guys probably know, I didn't start like athletes or movie stars or artists or whoever it is, a musician. They have this huge following from wherever their label or from radio or TV, and then they plug into social media. When you're starting out social media from nobody knows your name aside from like my first few followers, my mom, my grandma, and my friends. Like that's where it's really hard, is when you're starting from nothing as opposed to starting from a leg up or starting at the beginning like Gary Vee did, or some of these people that ex-professional athlete or musician that get into this space. They have a huge leg up on the competition. So yeah, starting at that point, which I don't think you guys were probably professional athletes. I mean, Rod looks like he could have been a rock star, maybe like a Kit Fiend or something.
He was a rock star.
aside from that, yeah, it's pretty tough to start from nothing. You got to bootstrap it.
Okay, so before we get into real estate investing, and we're going to talk a lot about that, but give us a couple tips. So I'm mostly like personally interested in this because I've largely ignored a lot of social media, personal social media for years. And my marketing team is like, all right, Christian, we've got to now go out there and build up your personal brand, right? So this is like me asking for personal gain. Give me some tips on how you did it so that I can, duplicate some of that.
Yeah. So being consistent, which I know is a pretty broad answer, but I'll try to, color it in a little bit. But being consistent is extremely important. Even to this day, the algorithms, I study them like crazy. You know, they want me to talk about my debt and, you know, my real estate, and that's it. And every time I try and venture into personal things or something else, the videos bomb.
Oh,
Even with
that
a
is
decent audience,
interesting.
they still bomb. Like I did, you know, I have 1.7 million followers on TikTok, and I did a video on my house that I just built. You know, here's how I built this house. Let me give you a quick house tour. It's got like 3,000 views. You know, they're not pushing it out. So just being consistent. And you know what I did on TikTok was I just posted one video a day for 30 days as I started. Then I went back and looked at the videos that did the best, and then kind of started to double down on, you know, was it the topic? Was it the delivery? Was it the song? What was it? And just really, really started to analyze on, like I said, like a psychotic level, everything, and just pushing through. So my advice would be, you know, be consistent, do it as, you know, every single day or at least a few times a week. Go back and look at what you did and really analyze why you think it did well. Because, you know, of course, the algorithms have their fun things where they'll push videos or won't push videos, but in general, good content is not going to get suppressed too much. So going back in and looking at that, and then just getting comfortable. I think a big thing for me was I tried to do videos like other people like Grant Cardone, or like, you know, I'm buddies with King Kong or Ryan Pineda, some newer social media guys, and trying to do videos like them. As soon as I started to just really just be myself, be authentic, be real, and not try to be those guys. Now I don't have the story of those guys, but I have my own story. Just pushing that out. I'm normal, and that's my story, is I'm normal and I did cool stuff. So I think just getting comfortable with myself was a big part of it.
Very cool. Good advice. Okay. You had mentioned one of the things that you've accomplished that you're proud of. It's really cool. You're able to build $40 million in your real estate portfolio. And I know it was in a relatively short time, like under a 5-year time frame, using other people's money. Now, I know you can't get into all of the details, but maybe tell us a little bit about how you did it.
Yeah. So what I've done with houses and apartments and self-storage facilities is, you know, the BRRRR method: buy, rehab, rent, refinance, and repeat. Or I changed it to scale. But buy, rehab, rent, refinance, scale, which is finding distressed real estate assets, whether they're houses or apartments, whatever they are, you know, using somebody else's money to buy them, and then, you know, either raise rents in the apartment or repair whatever. And then, you know, after enough value is added to it, then you get a loan from a bank and pay off the person you borrowed the money from. That's an obviously extremely simplified part of it, but you're just finding a distressed asset and you're using somebody else's money to buy it, and then, you know, use a bank loan to pay that person off, and then you have a 25, 30-year mortgage at extremely low interest rate that allows you to cash flow. And then real estate do what it do, especially recently, goes up in value. You know, you get the price goes up and the tenant pays the mortgage down. So like one simple clean sentence is you use other people's money to buy cash producing assets, then you use the cash and the equity those assets produce to pay off the people you borrowed the money from, all while you owning the asset. So it's a pretty simple yet powerful concept. Once you wrap your mind around, you can literally create as much wealth as you want by using debt. It's a crazy thing that we're taught the exact opposite growing up.
Yeah, and it's almost like you've got it down to, like, it's formulaic, right? Once you get it down.
Yeah.
Okay, so economic conditions change from time to time. So tell us about why you believe it's possible to find, fund, and scale rentals in any market.
Yeah, I think because it's all about buying at a discount. Like, I am not one of those doomsdayers. You know, obviously the market's softening. Obviously things are shifting. I'm not like in denial, but I think I saw a stat the other day that list prices have gone down like 2.5% in the past 5 months. And that's list price. That's not even home values. That I can list something for 10 times what it's actually worth. List price doesn't really mean anything. Right. But, you know, the market is going to shift and soften. So having some perspective and knowing that if I'm all in 75% of every asset I buy, that's 25% equity, that the market can shift a lot. You know, 10% would be a ginormous shift, 15% in my opinion, in, you know, 12 to 18 months. Even if that's the case, that my asset went down 10, 50% in value, I still have equity built in. I'm still collecting rent. As long as you're not over leveraged and you manage your properties properly and have pride in ownership. I collected 98% of rent during COVID because I'm not a slumlord. I communicate with my tenants. I treated them fair. I really, you know, ran them through the coals before I approved them. And, you know, we respect each other for for the most part, they respect me, not always, but just having a good base foundation of cash producing real estate that people have to rent no matter what. Even I think rent's gone up every year on national average every year since 1900, except 1 year. So rents are going to continue to be collected. They're going to continue to go up along with inflation. And as long as you're managing the asset properly, who cares what it's worth? My $40 million real estate next year could be worth 35 million. Guess what? In 20 years, I promise it's going to be probably worth 75 million. So even if I stop buying now, so real estate, doubles in value every 15 years, going back to 1900. So just jumping on that asset and managing it properly, I think, is the key part, and having good banking relationships. It's not bulletproof. It's not, depression or recession proof, but it's pretty darn close. If I told you, Rod, you could buy a stock that's guaranteed to double in value every 15 years, you'd think it's, a made up stock, but that's what real estate is. You just got to manage it properly and not, lose sight of what's important.
So follow up to that, how quickly are you moving from 100% other people's money to the bank loan?
So on my single family rentals, it's usually like 2 to 4 months, fix it up and you get it refinanced. On my apartment complexes, it's like a 18-month to 36-month play. We buy 20% down using private lenders, 80% down with bank funding. And then, over those first year to 3 years, we're adding value by increasing rents to about 90% of market. We like to be a little bit below market rent, but we're obviously buying it in our analysis well below market rent, and then minor fixes and getting efficient with expenses using our software and our in-house management team allows that net income to grow pretty quickly, pretty substantially. That creates enough equity that at that point we refinance and pay back our private lender.
Got it.
How are you guys handling like the property management? Just out of curiosity.
So we've done a few different things. At first, my business partner Luke and I had full-time jobs, so we hired it out from day one. It was fine, didn't love it. We had a few rentals, but eventually we took it in-house. Hired somebody part-time to do it, and that's grown into a pretty good team. We have about 275 rental doors, so we have we started two companies. One that manages our 140 single-family houses, and the other one that manages our 135, whatever it is, apartment complex doors. So just in-house teams of 3 or 4 that manage those 2 different asset classes. They're sitting right out there outside my office door. So we're just basically started our own property management company.
So are your most of your stuff in the same geographic area?
Yeah, it's all in St. Louis.
It's all in the same area.
Yeah. Mm-hmm.
Yep. Makes sense. Okay. So most of the people listening to our show are existing real estate investors. A lot of them do like syndication investing and things like that. But there's obviously going to be people who just are trying to figure out how to get started. They're trying to get over the hump. And so I guess my question is, this is, you've been doing it now for 5 years, but like maybe talk about what helped you get over the hump, or any advice you could give to somebody who's in that place where they're wanting to get moving, they're wanting to start investing, but just having a hard time.
Yeah, I think the biggest thing is you got to connect with the community. I think it's ideally investing locally if you can. Obviously you can invest nationally in other markets, but locally, the market you live in or grew up in, it's almost like insider trading. You have insider knowledge of the market and the trends compared to these big national companies or other bigger people that are kind of looking around everywhere else. So I suggest locally if possible. If it's not possible, you're not going to be able to do a bird deal in downtown LA. I understand that, but if possible locally, but then plugging into whatever that community is, getting involved in your local meetups, your local Facebook groups, going out and meeting people that are actively investing. You're going to learn through osmosis, but if you go to your local meetup, you're going to meet a hard money lender. You're probably going to meet private money lenders. You're going to meet a contractor. You're going to meet a bank. You're going to meet an insurance agent. You're going to meet real estate agents. You're going to meet wholesalers. Like, it's crazy. People that don't know about the meetups, literally everybody you're going to want to meet goes to them. And they're not the people that are behind a keyboard, maybe investing. They're out, they're getting in their cars and they're driving to these meetups. So they're active investors. So number one is get involved in your local community. And number two would be leaning on other people's knowledge. So many people are so, I don't know if it's stubborn or naive or what it is, but whether it's paid or not, leaning on somebody else's knowledge and experience via a mentorship, a mastermind. I don't know one ultra successful person that doesn't lean on somebody else's knowledge as an expert in the space. I always use the Tom Brady analogy. I'm, not like a huge Tom Brady fan, but everybody kind of agrees he's the best ever. He has like 8 coaches. He's the best ever to play quarterback, but he still is not, he's not naive enough or not big-headed enough to think, I know nutrition better than nutritionists. I know flexibility in arm angles, better than some. He knows that other people are more knowledgeable than him, so he brings them into the fold so he can up his game. So many people like, I don't need this course or this help. I'm going to, figure it out on my own. And then they stumble through the first 2 deals and quit, as opposed to, leaning on other people's knowledge and spending a little bit of money to get 100x return by sticking with it and finding the most efficient path possible. So those are my 2. There's obviously a million things people can do, but leaning on the community and then leaning on other people's knowledge. It doesn't have to be a paid mentorship, but some type of community of people that are doing it will make all the difference in the world.
Yeah, it's great advice. Okay, so we often talk about debt in the sense of there's good debt and bad debt, right? A lot of the strategies we use include using debt. So we're believers. We often refer to it as conservative debt. So in your mind, how do we make sure we're only taking on good debt?
Yeah, so I look at it, trying to keep things as simple as possible. So debt is borrowing money. I think we agree on that, right? Mm-hmm. So debt is borrowing money. So good debt is borrowing money to buy an asset that produces cash and grows in value. Bad debt is borrowing money to buy something that, either doesn't produce cash or doesn't grow in value. You can buy your personal house, not producing cash for you, but it's grown in value. So it's kind of in the middle. But in general, an apartment complex, a business, a single family rental, if you're borrowing money to buy something that, assuming you're managing it properly, goes up in value and produces cash, that's good debt. That's how you create wealth. That's how Amazon started. That's how Facebook started. Mm-hmm. These big companies didn't start with, millions and trillions of dollars. They borrowed money from angel investors, from banks, from friends, from family, and they started to build companies that produce cash and grew in value. I'm not smart enough to start Amazon, so I just stick to housing. So that's what, it's a level playing field for all of us. I think we all can understand how to buy and rent housing and apartments. So it's taking what these billionaires have done and these companies have done, Apple, all these companies, but dumbing it down to a simple level of real estate and shelter. So that's what good debt is. And then bad debt, is borrowing money to buy something that's not going to do that. I have a few vehicles. My wife drives a nice car. I borrowed money at 2% rather than wrote a $100,000 check. So I think, bad debt is if you have cash and you can afford it, it's not a bad thing. It's just not a way to create wealth. I love debt. I think leveraging other people's money and information and knowledge at low cost is the way to live life, to buy your house, to buy your cars, to buy your vacation house, to invest. But just people get in trouble when they borrow people's money to buy something they can't afford or to buy something that doesn't produce cash and grow in value. Right. So long-winded answer, those are kind of the ways I look at it.
That's great. Yeah.
Okay, 2 questions about deals. So the first one is about how are you getting your deals funded these days? And I know, like, the markets are changing and stuff, but maybe you can just talk about how you've done it, realizing that there's going to be change, but how have you done it up to this point?
Yeah, up to this point, we've used private lenders for the down payments, for the entire payments. If it's been a single family burst deal, for the apartment complexes, we use them for the 20 or 25% down. Use a little bit of hard money for, the single family rental property. So, the short-term funding has been hard money and private money, mainly private. And then the long-term funding has been mainly small local banks still, or regional banks. We've got a couple of deals, some agency debt, some Freddie debt, but in general, it's been, just small local banks that you build relationships with, because these small local banks, most people, I guess, don't understand that they can almost literally do whatever they want if they're not selling it off on the secondary market. They don't have to have a seasoning period. They don't have to have arms. We took our entire portfolio in 2020 and refinanced it on one note, and the local bank gave us 30-year amortization at a 10-year arm, at an extremely low interest rate, and allowed us to cash out, $1 million. So that's the things like that can't be done with these big banks or, with a lot of lenders. So building relationships with these small local banks. is the way to go, in my opinion. And that's what I'm going to continue to do as the market shifts and as things change. Interest rates are going to go up a little bit. They obviously have gone up a lot, but just factoring that in along with rent increases and things like that. So I'm not planning to change a ton. I'm not, over leveraging. I'm not borrowing 100% of the value of something. I'm still usually borrowing 75% of the value, just been able to, get them at a discount. So I'm not looking to do a ton, but those are kind of the sources, or the short-term and long-term lending.
Yeah, good stuff.
How do the traditional lenders view the hard money lending? So if you're doing the 20% down through the hard money, then how do the traditional lenders that are lending the 80% view that?
So when we put the 20% down on the apartments, that's always private money. We don't use hard money for that, because most of the hard lending companies we work with, they're not going to want to be in second position. So private lenders are usually, it's a relational business, relational transaction. They understand the risks and the rewards of being in second position. So we obviously explain that to them very well and protect them at all costs and lengths. We borrowed over $50 million between our flipping company and our rentals, in and out, and we're always paid our lenders back whether we made money or not. So having that track record, makes private lenders comfortable to be in the second position. But the institutional, not the exact right word, but the banks and the hard money, the companies that lend money, we aren't able to have either of them in second position. So if we use hard money lender, it's going to be 100% of purchase price and maybe rehab on their deal.
Okay, so I think you addressed this a little bit earlier as far as finding deals, and kind of how people can get started with relationships and things like that. But in a market like now, how would you suggest people go about finding deals?
Yeah, so deals, in my opinion, in my opinion, and what I've seen over the past 2 or 3 months, have been easier to come by. A lot of the fly-by-nighters, the weekend warriors, the people that have got in the space over the past 2 years that have overpaid and over-rehabbed and still made money because the market carried them and kind of winded their back. A lot of those people are scared because of what they read or see or hear, or they just have had a tight deal or two because the market shifted. So deals have been easier to come by, but we are going to buy probably 300 houses this year in our flipping company, and 175 of them are going to come strictly from networking, $0 in marketing spend. So that's where especially newer investors, in my opinion, need to start, rather than spending money on an email or not email, but on like a direct mail campaign or like Facebook ads or something like that. Rather than spending the money and having to deal with the calls and negotiating, just let somebody else do that for you, and just deal with wholesalers or real estate agents that are in direct communication with the sellers and do that all for you. So spending some time networking at your local meetups and on the Facebook groups and just in general talking to people is the first place to start, for your wholesalers and your real estate agents and even brokers. Our last 4 apartment complex deals have came from the same broker that we've been working on a relationship with for the last 2 years. So just getting, around the people that are around the deals is the easiest and best source, no matter what the market's doing. But if you're going to spend a little bit of money driving for dollars or, direct mail campaigns or Facebook ads or something like that, it's a pretty inexpensive way to get across deals. But if it's not your full-time job, you can't send one direct mail batch out and get a ton of buys. You're going to have to do consistently for months on end. So if you're not committed to spending a few $1,000s a month, probably just let that go and just deal on building relationships.
Yeah, sounds like a pretty consistent answer. Relationships.
Gravy. It's the gravy train is what we call it. You build a relationship with 10 wholesalers that are consistently bringing you deals. That's our buyers do. That's 20, 25 deals a year for however long you want to keep those relationships going, and they're free. So, maybe you got to go grab a beer with them or something and continue the relationship. But other than that, it's a pretty inexpensive way to do it.
Nice.
So, Sam, I haven't done much with the in the meetups. So they're pretty easy to find. Are they common? Like, is it something that most markets are just going to be you can easily tap into?
Yeah, every market has one or markets with at least maybe 100,000 MSA. But just meetup.com or on your local Facebook groups, just asking where the local meetup is or just Googling them. They're mainly focused on the single family game, not as much the multifamily game. A little lower barrier of entry for most people, but there's multifamily ones, there's syndication ones, there's single family ones. So they're just people connecting, and experienced investors that are doing deals understand the power of having a strong network. So jump on what they're already doing. If you're new, go do what they're started or what they're doing. Our meetup has 2. We have one here in St. Louis 250 people every single month coming, and we give as much as we can away. The knowledge, the information. We buy dinner for everybody. There's a cash bar. Everyone just has fun, and networks and deals are done there every single month. So it's a fun thing to do as well.
Okay, Sam. So I listened to you on a podcast a couple weeks ago, and you had a cool acronym for SCALE. Everybody loves to scale the business. You added SCALE to the BRRRR method. Talk to us a little bit about what SCALE means for you.
Yeah, so the origin of it was, the BRRRR method: buy, rehab, rent, refinance, repeat. And repeat to me is just go back and do what you did. That's cool, but where does the growth come? Where does the scaling come? Where does the tangible efficiencies come from? So I got to thinking and went through several acronyms, and ended up coming up with a decent one for SCALE. Because if somebody wants to scale, I think most people that are listening to this podcast that are investing, they want to do more than one deal, and they want financial freedom and time freedom. They don't just want to have a few. So in order to do that, you need a scale. So scaling, like the BRRRR method, is an acronym. And I think it kind of pretty much works for any business. It's worked for all of our businesses. That's kind of how I got to it. Of our $40 million in real estate, we bought 25 million in the past 15 months, because we've scaled that business. We've scaled our rentals. I've scaled my education. So this is how I've done it. So the S in SCALE stands for systems and processes, going back and creating systems around every step. It's not the most fun part. So if you're not a systems person, I'd hire somebody or partner with somebody that is. But if you can create systems around, let's say, rehabbing houses, for example, you're naturally going to get more efficient if you have a scope of work spreadsheet and a contractor spreadsheet and ways to get lien releases and all this stuff that goes into rehabbing that people don't think about. If you have systems to get them done efficiently, maybe that rehab takes 3 months rather than 5 months, and then eventually 2 months, and then you can do 5 in a year rather than 2 in a year. So things like that. It's the least fun, but probably the most important part is creating systems, no matter what your business is, but real estate we're talking now, around whatever you do in your real estate, whether it's buying or rehabbing or whatever it is. And then the C stands for coaching, leaning on your coaching, leaning on community, having somebody else that's already been there, showing you the most efficient path possible, just keeping you out of the gutters, keeping you out of the ditches, just keeping you in the lane. So leaning on coaching, leaning on other people's knowledge is the C. The A is the most fun part: taking action. You got to go out and take action. People learn a ton from your guys' podcast. People learn a ton from coaching programs, but you're going to learn 80% of it on the job. You have to get over the analysis paralysis. You have to go out and take action and screw up and make mistakes and fall forward and learn on the job. So that's the A, is taking action. The L is lead flow. You got to increase your lead flow. It's a numbers game, whether it's apartments or houses. You're going to have to look at 10 to 15 before you buy one. If you want to buy 10 houses this year, you can, but you got to look at more than 10. You got to look at 100 or 75. So you have to do things to increase your lead flow, whether that be spending money on marketing, whether that be doubling down on going to meetups and building relationships. You just have to get the top of the funnel full with leads if you want it to trickle down to assets. And then the E is extra funding. It's not just funding, it's extra funding. You need multiple private lenders. You need multiple hard money lenders. You need multiple small local banks or connections with agency debt. Whatever it is, you need to have multiple places to go to when a good deal comes across your plate. Money's not the reason you're not buying it. The reason you're not buying deals is you don't have deals. You don't want a home run to come across your plate and you don't have the funding for it. So even if you don't have a deal, get extra funding lined up at all stages: private, hard money, and then longer term debt. Just build all that out. It takes time, but if you can have like that SCALE acronym to kind of follow, at least guide you along the way, hopefully that'll help you be able to scale a little bit quicker.
I like that. When I heard it the first time, I thought it was brilliant. So it was systems, coaching, action, lead flow, and extra funding. Did I get it right?
Awesome. You got it. You're a quick learner. I don't care what Rod says about you.
As long as I have something to cheat with, and I'm pretty good.
There you go. I like it.
Okay, so tell us a little about your company, Faster Freedom.
Yeah, so Faster Freedom is that social media, that education deal that I talked a little bit about earlier. About 2 years ago, rentals were doing pretty good. Our flipping company was, I think probably doing like 150, 175 houses a year. So the active income was coming in pretty good, and the long-term income was coming in as well. The wealth was being built. But me and my business partner, who all the stuff I've talked about, we own 50-50. It was coming to the point where we had great people hired to run the companies, and we were each working, but it was like, let's divide and conquer and let's try to start a new revenue stream. You run the flipping companies and I'll start this education deal, because we had posted on Facebook a couple of times about some deals we were doing, and people were flooding our inbox with questions and comments and, likes and shares. And it got some momentum because we're actually doing it. We're not just talking about it. We're out there doing it. So I decided just to start to grow social media following. So summer of 2020 started to, YouTube first. That was slow. So I decided to get on Instagram, and then this TikTok thing, I decided to start that. And then just started to build an audience over the past 2-ish years. And then about a year ago, decided to throw in a mentorship, because at first it was just, I was growing an audience. I wasn't trying to monetize anybody. I'm just like, here's free information, take it or leave it. Here's what I've done that works. Do this or don't do that. And it started to, people resonate with that, not trying to be sold something every 2 minutes. But I had so many people that wanted a mastermind or a mentorship or coaching. So I developed a program for that we launched about a year ago. And a little less than a year ago, we have 750 students now. So a lot of students, a lot of people really crushing it. It's on how to build a rental portfolio without using any of your own money. So the goal is still just the big brand, Faster Freedom. The goal is to be top 5 real estate investing brands. Bigger pockets, Rich Dad Poor Dad, Faster Freedom, to be in that realm within the next 4 years. And I think we're well on our way. But yeah, the goal is just to provide as much free information as possible, give tactical and tangible things for people to go do, and then a certain percentage of those people are going to want more. So we have a product for that now. So it's a pretty soft sales pitch on our end.
Yeah,
very cool. So you're providing a whole lot of free education content, and then for that person who wants to really get into the nuts and bolts of how you've done it, that's where they get into Faster Freedom and take it to another level. Does that sound accurate?
Exactly. Yeah,
Nice.
I mean, most information's out there, but somebody needs it packaged in
for sure,
exact right formula, and exactly what to do, and coaching calls, and points of contacts and contracts and leases, all that stuff that you can't really give away on social media, and you don't have that captive audience of somebody spending money. The transformations in the transaction, I could give it away for free, but if I charge for it, they're going to take action on it, and it's just categorized for them to go out and actually just hit the ground running.
Yeah, that's awesome. Okay, tell us a little bit about Ordinary Guys, Extraordinary Wealth. What was the inspiration behind the podcast?
Yeah, the podcast. So we just launched it a little over a month ago. So I've been wanting to do it for a while, but didn't really have the time, and wasn't just going to half-ass it, I guess, for lack of a better word. So we've been developing it for a few months now, and just launched it about 40 days ago. We launched on the 10th of last month. So it's been really fun. We started, with a few episodes to get the ball rolling, and now we're doing 2 a week, and it's me and Lucas. He does the flipping stuff. I'm, the education. So it's the time for us to kind of talk and hang out. We've been friends since middle school. So we're just having fun talking, hanging out. It's got off to a pretty good start. It was ranked pretty good at first, and just kind of building that momentum. But it's just, awesome. As you guys know, on podcasts, you can really develop a relationship with your audience. In 10 minutes on TikTok, literally somebody's going to see maybe 75 different people, and on Instagram maybe 20. But on podcasts or YouTube, you're just going to see that one person really develop a relationship. So it's just a chance for us to let down our hair, even though Lucas doesn't have any hair, but let down our hair a little bit, and just have fun and make fun of each other, and just talk about our experiences, and try to guide people along the path and have fun with it. So it's been a lot of fun.
Awesome. I listened to it, and I can verify it was fun. It was cool to listen to. So you guys did a good job. Okay. Did we cover all the ways that people can work with you?
I just follow me at Sam Faster Freedom on whatever social you're on, and hit me on Instagram if you want any more information. But yeah, just enjoy. Obviously, your guys' podcast is awesome. So hopefully they continue to listen, and I'll give you guys a 5-star rating. And then if they have any more interest, to check out our podcast as well. And just dig in, and like anything else, I encourage people to just poke around. If they like it, stick around. If not, no big deal, no pressure.
Awesome. Sam, you've been a lot of fun to have on. Thanks for coming and hanging out with us. We appreciate it.
Appreciate being on.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.